SoFi stock, the fintech that could become a banking giant. If you had invested $10,000 in SoFi a few years ago, you've probably experienced one of the most volatile rides in fintech. This company went from over $20 down to around $5, then back above $30, and now around the high teens. So the big question investors are asking right now is SoFi still one of the best fintech growth stocks in the market, or is the hype finally fading? In this video, we're going to break down what SoFi actually does, why its growth has been so explosive, the biggest risks investors ignore, and whether the stock could realistically double again. Let's dive in. What SoFi actually is first, a quick explanation of the business. SoFi Technologies started as a student loan refinancing platform, but today the company has transformed into something much bigger. SoFi is trying to build what it calls a financial super app. Inside one app you can get banking, loans, investing, credit cards, insurance, crypto, financial planning. Basically, SoFi wants to be your entire financial life in one place. And this strategy is extremely important because financial companies make more money the more products a customer uses. So the real goal isn't just users. The goal is multi-product users, the three core businesses. SoFi actually operates three main business segments. Lending. This includes personal loans, student loans, home loans. This is still the largest revenue driver for the company, but lending is also cyclical. When interest rates rise, loan demand can drop. Financial services. This includes the app ecosystem, checking and savings, investing accounts, credit cards, insurance. This is the fastest growing segment, and the real value here is customer acquisition and retention. Technology. Platform. This is the most underrated part of the company. After acquiring Galileo Financial Technologies, SoFi now sells banking infrastructure to other fintech companies. Think of it like AWS for fintech. Companies can plug into SoFi's back-end systems to build financial apps. This creates high-margin recurring revenue. The SoFi growth story. Now, let's talk about why investors got excited about this company. SoFi has been growing extremely fast over the last few years. Millions of new members joined the platform. Products per user increased. Revenue surged. A key metric to watch is member growth. SoFi has been adding hundreds of thousands of users per quarter, and importantly, users are adopting multiple products, which increases lifetime value. This is exactly the playbook used by companies like PayPal, Block Inc. The more financial tools a customer uses, the harder it becomes to leave the ecosystem. Why the bank charter changed everything. One of the most important moments in SoFi's history happened in 2022. The company received a U.S. bank charter. This gave SoFi a massive advantage. Before the charter, SoFi had to rely on partner banks to fund loans. Now it can use customer deposits. Why does that matter? Deposits are much cheaper capital, which means SoFi's profit margins improve dramatically. This is one of the reasons investors believe SoFi could eventually become a major digital bank. The profitability. Question for years, critics said SoFi will never be profitable, but the company has started showing consistent profitability trends. Margins are improving because of deposit funding, higher interest income, technology platform growth, better operating leverage. As the company scales, fixed costs spread across millions of customers. This is why fintech companies can suddenly become very profitable once they reach scale. The bear case, major risks. Now let's talk about the big risks investors need to understand. Risk 1, loan concentration. SoFi still relies heavily on personal lending. If the economy weakens, default rates could rise, and that could hurt profitability. Risk 2, interest rate sensitivity. Fintech lenders are highly sensitive to interest rate changes. Higher rates can reduce loan demand, Increased credit risk. This makes SoFi somewhat tied to macro conditions. Risk 3. Competition. SoFi is competing against some massive players. JP Morgan Chase, Bank of America, Robinhood, markets. Traditional banks are spending billions on digital platforms, so SoFi's advantage may not last forever. The bull case. Now, let's talk about why many investors are still extremely bullish. Digital banking trend. Traditional banks are expensive to operate. Branches, staff, physical infrastructure. SoFi runs almost entirely online. That means lower operating costs, younger customers. SoFi's average customer is much younger than traditional banks. That matters because young users can become customers for decades. Lifetime value becomes enormous. Financial super app potential. If SoFi successfully becomes a one-stop financial hub, the upside could be huge. Think about how much money companies like PayPal, Square, Cash App make per user. If SoFi captures similar engagement, revenue per customer could grow dramatically. Now we have today's sponsor. Most traders lose, not because they're bad, but because they're trading blind. They are juggling charts, news, indicators, trying to make sense of it all in real time. That's where Trend Trade Pulse comes in. Your all-in-one trading companion that helps you move faster, smarter, and with confidence. Get real-time market alerts so you never miss a move. Track your favorite stocks and spot trends instantly. Custom alerts, so the app watches the market for you. No more guessing. Get alerts to your phone. Click the link below and try Trend Trade Pulse now. Valuation discussion. Right now, the big debate is valuation. Is SoFi cheap or expensive? On a traditional metric like price to earnings, the stock looks expensive. But high-growth fintech companies often trade at premium valuations. Investors are essentially betting that SoFi could become something like a top digital bank with tens of millions of customers. If that happens, today's valuation might look cheap, but if growth slows, the stock could struggle. My personal investment thesis. Here's the real way to think about SoFi. This is not a traditional bank stock, and it's not purely a fintech either. It's more like a hybrid between a bank, a fintech platform, and a software company. If the company succeeds at building a financial ecosystem, it could become one of the most important digital banks in the US, but it still carries growth stock volatility, meaning the ride could remain very bumpy. Final verdict. So is SoFi stock a buy? That depends on your investing style. If you want stable dividend income, this probably isn't the stock for you. But if you're looking for a high growth fintech with massive potential, SoFi remains one of the most interesting companies in the market. The key things to watch going forward: member growth, deposit growth, loan performance, technology, platform revenue. If those continue improving, the long-term bull case could still play out. If you enjoyed this deep dive into SoFi stock, make sure to subscribe and let me know in the comments. Do you think SoFi becomes the next major digital bank, or is it overhyped fintech? I'd love to hear your thoughts. This content is for educational and informational purposes only. You should conduct your own research or consult with a certified professional before making any investment decisions. Past performance is not indicative of future results. Some AI tools have been used to create, edit, or generate content. If you found this helpful, hit the like button and subscribe, and check out the link in the description.